So welcome all to this event, a conversation with Bruce Greenwald on the occasion of the publication of the second edition of his value investing textbook, Value Investing from Graham to Buffett and Beyond. The second edition finally came out after a long wait. We're delighted that is already here. And we're going to have a conversation with Bruce about what's new in the second edition, but also about, of course, his views on the state of value and value investing, the states of markets, and the future of value investing and of financial markets in general. Bruce, of course, doesn't need an introduction. He will get one nonetheless. He's the Robert Helbrom Emeritus Professor of Asset Management here at the Columbia Business School, where he has been a phenomenal presence since he joined from HBS many decades ago. Bruce is an academic of enormous distinction, as we all know, an intellectual powerhouse, and a phenomenally impossible debater. I was at home yesterday with Bruce, discussing and talking a little about the event today. And, you know, talking with Bruce is always an intense experience and one that is not for the faint of heart. So I'm looking forward to yet another conversation with Bruce. So welcome, Bruce. Thank you for the event. Thank you
for the kind introduction. But I ought to warn people that, as usual, my idea of a good conversation is I talk and everybody else listens.
Yes. So this is why a Zoom conversation is ideal. So the way we're going to do this is we're going to sit on conversation about, as I said, the book and broader topics. We're going to be talking for about 30, 40 minutes, give or take. And then we're going to allow for questions. Please do ask them in the Q&A tab in your Zoom screen. We'll read them, we'll process them, and either Meredith Trivedi, the Administrative Director of the Helbrom Center, or myself will read them, and we'll have a good conversation, and we'll go for an hour and 10, 15 minutes, depending on how we all feel and how hungry we are at the end of this event. So, Bruce, I want to start by asking you about the timing of this publication. It was long in coming. You and I have spoken about this second edition for a long time of the Value Investing book. So why now? How come it's coming now?
Okay, so what you have to understand about Judd and I in these books is that we have a phenomenal ability to release them at exactly the wrong time. So that the first edition of this book came out in 1999 at absolutely the peak of the telecom bubble, when everybody said was value investing was dead. And I'm pleased to note that this book was done again in a period of the FANGs, where again, now in 2020, 2019, everybody again feels that value investing is dead. So we have not lost our gift for bringing out books at the wrong time. But let me say this. I think that at least this time, we have addressed, probably partially inadvertently, what I think are, at this time, the really big issues with value investing.
So very good. So let's talk about this, and let's talk about, you know, a topic that you and I have discussed often that I think the second edition addresses decisively, which is this issue of that we've moved obviously well beyond the original ideas of, brilliant as they were, of Ben Graham and David Dodd, and that we're thinking more seriously about franchise investing. And a little bit of a problem that we have with the terminology here, that value investing has moved well beyond kind of the original approach of David Dodd and Ben Graham. Can you talk a little bit about that? Can you talk about these?
I think it's important to start really with an understanding of what value investing has always been, as conceived by Graham, Dodd, and of course, Buffett and the other really distinguished value investors. And I think it's really consists of two basic ideas. The first is you look for opportunities where nobody else is looking, and you stay away from the crowds that are overpaying for glamorous opportunities. So there is that idea of just statistically cheap, ugly, out of fashion. And I don't think in an important sense that has gone away. Now, if you look at the statistical value models, simple statistical metrics of what is poor, out of fashion, overlooked are no longer as reliable as they were. And we'll talk about reasons why I think that's the case. I think the second thing about value investing, and it's really where the value comes in, is that the Graham and Dodd tradition is a tradition of approaching valuations with a clarity and a precision that normal investors don't. It's more than just slapping a multiple on things and saying, okay, this is a growing business, it's worth 40 times earnings. It's more than just forecasting next quarter's earnings and trying to guess where the price is going. It's really about understanding what it is that you're buying. And there, I think that the really big change in this edition is that traditionally what Ben Graham and David Dodd bought were assets. And they bought competitive businesses or assets in competitive businesses. And for those, growth doesn't matter, because the force of competition means that if you invest in growth, you're going to earn the cost of capital. If you get organic growth, that's just going to attract more competition. And you're, again, unless you invest money, not going to earn more, and you're just going to earn a fair return. So I think that in their day, they focused on the part of the market where, and I think this is always important to understand, where their asset value, earnings power value approach was much better and a much clearer framework for incorporating externally obtained information than these stupid DCF models that superseded them. The problem is that they never dealt with growth. And I think that's where, because of fundamental underlying changes in the economy, value investing has got to adapt. Now, I don't think that means getting away from value, because really it's all about understanding how much growth is worth and when it's worth anything at all. So there is a value approach to growth. And I think in a sense, it's the growth investors who have to adapt. So I think value is clearly going to have to go in that direction. The second edition is really all about how to go in that direction, but at the same time, to be true to those Graham and Dodd principles of knowing what you're buying and having a really good valuation framework when you address the issue of growth.
Yeah. So in that sense, I think the real, and there's real value in those chapters 6, 7, and 8, and in particularly on the appendix that is illuminating of the second edition of the book, where, you know, it's very good job done on actually describing the analytics of growth and how does it fit on the valuation. So let's organize the discussion for our listeners today. So why don't we start with the, let's have a good discussion about franchise. So why don't we start with, what do franchises look like? And then we do go to the issue of some of the mechanics and the valuation of growth. So when we're talking about franchises, Bruce, what do these franchises look like?
Okay, so let me just say one thing first and absolutely clearly. If you are not in a franchise business, which is a business protected from competition by barriers to entry, which typically are the same thing as incumbent competitive advantages, growth has no value, because any value that's there is going to get competed away. So when you talk about value-oriented growth investing, you are talking about franchise investing. So if as a value investor, you're going to do this in the Graham and Dodd tradition, what you've got to first verify is that this company you're going to buy into has a sustainable franchise, sustainable moats in Buffett's language, sustainable barriers to entry. It turns out that you can actually measure a moat, and I'm sure Warren Buffett always knew this, but would never tell anybody about it. And it's the key to what a franchise looks like, and it's got two elements. So the first element is, if you've got an entrant coming in, what is the minimum viable market share that that entrant has to get to? And that's all about economies of scale. So it's how big do they have to have sufficient scale economies to be viable? If you look at things like distributing carbonated, caffeinated beverages, you pretty much have to get to 25% local market share to be able to sustain the distribution infrastructure you need, the marketing infrastructure, and the local advertising infrastructure. If you're part of a global automobile market, you can be viable at 1 to 2% market share, and you're not going to keep anybody out at that point. For things like cell phones, you look at cell phone companies, they start to be economically viable at basically 10 to 17% market share. So you start there. You're looking for a situation where the economies of scale make it hard for somebody to enter. And the second element to this equation is how hard is it and how long does it take for an entrant or a competitor to acquire that market share? And that really is all about share stability, which is driven by customer captivity and whatever proprietary technologies you can bring to the table to help keep competitors out. And there, the measure is simple. So if you look at carbonated soft drinks, caffeinated soft drinks, about 1/10 to 0.2% market share changes hands in any given year. If you're going to get to 25% market share at 1% a year, what you're talking about is a 250-year moat. If you're going to do it at 2% a year, you're talking about a 125-year moat. And that's a powerful moat. So the two elements you're going to look at there are the economies of scale and the proprietary technology and customer captivity that protects those economies of scale. For cell phone companies, you get to 15%. Typically there as much as 0.5% changes hands a year. So you're talking about a 30-year moat. For automobiles, you got to get to 1 to 2% and 1% changes hands a year. So you're talking about a 1-year moat, which is no moat at all. So what you're looking for are moats, minimum required scale for entrance, and the difficulty of acquiring that scale. That is economies of scale and customer captivity and proprietary technology. Ultimately, of course, to have the economies of scale you need, you want to be the dominant competitor in your market. So all the first and simplest test here is, are you the dominant competitor or the dominant firm in your market? So you start there, and then you look at the required economies of scale, whether they're network effects or whether they're simple fixed costs being spread out, and you look at the customer captivity, the customer behavior in the face of competition. Those are the elements you have to look for.
Can I ask you a question about this, about the issue of customer captivity? So I think it's a brilliant insight in competition demystifying, in fact, is the idea that the barrier to entry is this peculiar combination of economies of scale bundled with some form of customer captivity that gives potency to the moat. How deep do you go, Bruce, when you approach a new business in understanding the sources of customer captivity? You try to establish, well, it's something about habits. People like Coke over Pepsi, or they addicted to their Marlboro cigarettes, or is something about a network externality, or is it something about it's difficult to find an alternative? How deep do you go in understanding what is the true source of customer captivity that is giving that stickiness to the incumbent?
Well, I don't think you start there. I mean, I think that one of the wonderful things that Ben Graham pioneered was looking at history. So the first thing you want to look at is the history of share stability. I mean, if you take a 10-year period and you look at the average absolute share change that firms have experienced, so you look at shares at the beginning of the period, you look at shares at the end of the period, you see how much share on average changed hands for the average firm, plus or minus, and you divide it by 10, that's going to give you a share stability. And if you don't see that, you don't have to worry about the mechanics.
Exactly.
So you start with the history, and then you start to think about what is it that's going to keep your customers with you and away from anybody else. And the simplest one for high frequency purchases is habit. That it's not worth doing an extensive search to find an alternative to Coca-Cola. And people just naturally, for certain goods, prefer uniformity of experience over variety. So if people talk about variety, that's probably not going to be powerful customer captivity. Then there are search costs. If it's a complicated product and it's a high value product, finding an alternative is not going to be cheap. And that's going to keep customers with you. They're only going to change slowly over time. And finally, there are direct switching costs. So you've got all those elements you're looking for in detail. But as I say, in the Graham and Dodd spirit, you always want to start with the history.
So very good. So can we start talking a little bit about the analytical contribution of this second edition, which I really think is absolutely key, and how to think about the problem of growth valuation and how we incorporate it into the framework that we've been teaching to the students for many years. So can we
so I think the first, again, you want to start with a good qualitative understanding of what's involved in whenever growth creates value. And, in franchise businesses, there are three aspects of growth that create value that just don't do anything for you in competitive markets. The first, obviously, is organic growth. That's not a surprise. And you want to look at that and what the value of that is. The second is earning above cost of capital capital costs on reinvested earnings. It's sort of the value creation from reinvestment, which almost or usually means growth. And the third, which people don't normally think about as growth, is growth in margins that comes from steadily improving technology. Because if you're a competitive firm and the technology improves, all your competitors have it and it just gets bid out in the price. Whereas if you benefit from barriers to entry, your costs go down and you get to take home a substantial fraction of that. So you start there. Then again, the crucial thing about value investors, and it really is going to be what distinguishes value-oriented growth investors from ordinary growth investors, is you have to know how much to pay. And that means knowing what the growing operation is worth. And here is the crucial point of the book. You cannot do that in value terms. That when you've got a growth business, the value is so far out in the future and is so sensitive to changes in the growth rate and the cost of capital that it's really very hard or impossible to put an accurate number on what these firms are worth. But what you can do is answer the question, if I buy this firm at today's price, what kind of a return am I apt to earn? And it is that approach that I think is essential for value investors looking at growth. And you start with just sustainable earnings divided by the price you're paying, which is an earnings return. And again, you do that in a standard earnings power Graham and Dodd framework. But then you have to worry about how much do you get today in cash and how much is going to be reinvested and the value of which is going to be deferred into the future. So the next thing you have to look at and you have to incorporate in this calculation of return is, how does the management of that company divide those profits? What fraction do you get and what fraction gets reinvested? So say you're earning a 10% earnings return, it's trading at 10 times sustainable earnings. If they're distributing half of it, you got a 5% cash return and you got a 5% of your money being reinvested. The quality of management capital allocation determines what you're going to get for that 5% reinvested. And basically what you've got to look at the history of is how much value in acquisitions, in cost reduction projects, and so on, has this management generated historically for every dollar they've reinvested. You can think of that as a value creation factor. Do they make stupid acquisitions? And there are cases of this in the book where they basically get 20 cents in value for every dollar they invest. And this is actually a pretty good firm, except for the capital allocation. In which case that 5% reinvestment is worth 1%. If they create $2 of value because they're doing good acquisitions or they're expanding or their competitive advantages apply or they're focused on cost reduction, you could get as much as $2 for every dollar reinvested. In that case, the 5% reinvested is worth 10%. So the second thing you have to calculate is this value creation factor, which is the quality of capital allocation. So you take the retained earnings percentage and multiply it by that value creation factor. Then you've got organic growth, and it's organic growth both in sales and in margins that we talked about from cost reduction. And you're going to look at the history of that, because you've got a lot of history. Trying to forecast dramatic changes in the future is almost impossible to do, and Graham and Dodd never tried to do it. It's all about sort of looking at history and betting on continuity. So look at historical growth rates. Now, if those historical growth rates are 12%, they're not going to happen in the future. I mean, the best you're going to do in the long run, because franchise investments or long run investments are 3 to 4% above GDP growth. And then maybe a little bit in margin growth. So the organic growth might be 7%. What you can do then, and again, this is an important Graham and Dodd principle, you have the cash return, the reinvestment return, and the organic growth return. The reinvestment return should translate into a growth rate. And you can look at sort of whether the overall growth in earnings has been close to or equal to the sum of the reinvestment return and the organic growth rate. Once you have that number, you'll know what you're looking at. This is going to be an 8, 6, 10, 12, with for luck, sometimes a 15% return, and you know what you're buying. Ultimately, you're going to compare that to what alternative investments pay. And if the market, like it is today, is earning somewhere around 6%, then that's a margin of safety in returns that's really pretty good. Now, there is only one thing that you have to be really careful about here. You will notice that what we're talking about here is really a detailed, careful, expanded dividend discount model, which is just the cash return dividends divided by the price plus the growth rate. That model is wrong. Growth rates and growth returns are not the same thing. A growth rate applies typically when you calculate it based on the history we've talked about to intrinsic value.
Yeah.
So if the intrinsic value is 2 billion and that organic growth rate is 3%, you're going to be getting 3% of 2 billion, which is 60 million. Doesn't matter what the market price is, that 60 million is going to get divided by the market price. So the market price is 4 billion. It's not a 3% return, it's a 1.5% return. So that growth rate has to be multiplied by the ratio of the intrinsic value to the market value to get a growth return. The problem, of course, is you can't calculate the intrinsic value. But here is the thing. When a company is fairly valued, you're paying a fair price, the intrinsic value and the market value are the same. So an estimate making that assumption is going to be an accurate estimate of returns. So if there's no margin of safety in returns, you calculate the return and it's 6 or 7%, that's what you're going to earn for that growth rate. On the other hand, if you are careful, so that you've got a 12% return against a 7 or 8% cost of capital, that means that intrinsic value is above the market price. And that means that actually this is a better bargain than it looks like. But here's the thing to be careful of. If you think you're getting a 6% or 5% or 4% return and you're just optimistic about the future, or you pay a very high price, so the cash return is very low. So if you are getting a return that's below the cost of capital, that means the market value is above the intrinsic value, and the value of that growth may be as little as a half to a third of the growth rate. So in this kind of careful Graham and Dodd based growth investing, the critical thing is, and I think of this as the third element of value investing, you have to be really disciplined. You cannot be optimistic about growth rates, because you're going to be fooling yourself, because you're leaving off necessarily this ratio of intrinsic value to market value from the growth term, and that can kill you if you're too optimistic. So your benchmark return ought to be significantly below the cost of capital. And then there is one other crucial thing that you have to, if you're going to invest intelligently in growth, worry about. Franchises don't last forever. If you think a franchise is likely to last, so it's got a half-life of 50 years, Rule of 72 says that is on average, because you don't know when it's going to die, but the average arrival rate of the death event for that franchise is about 1.4% a year, which is 72 divided by 50. If you think that's a 30-year franchise, that fade rate or that death rate is 72 divided by 30, which is 2.4%. And you got to have a margin of safety to cover that fade rate. So you cannot ignore the fact that these franchise sizes go away. If you're going to invest in railroads, you're going to invest in old technology metallurgical companies, you better have a margin of safety and returns that covers a half-life of 20 years or conceivably less, which is a fade rate of 3.5%. But if you do all that in returns, you're going to start to be making intelligent growth investing decisions, which are Graham and Dodd, Buffett, value investing decisions. And the only, I'll leave it there. Let me stop there.
Yeah, so can I get, I mean, there's so much there that I would like to unpack a couple of things also in line of what people are asking, the attendees are asking. So I'll come back to this issue of the fade rate, which I really think is important. But, you know, I want to investigate a little bit more, Bruce. I mean, one thing that I've always been struck by is that once you start thinking about growth, you really have to start thinking about capital allocation, the quality of the management, and so on and so forth. And you mentioned acquisitions as giving you a window on the quality of capital allocation in that firm. But what if you actually don't have many acquisitions for whatever reason in that company? How do you assess the marginal return invested capital of a company? Is it you look carefully at the segment information and try to assess to the best possible how much are they deploying of those retained earnings across different segments? What kind of analysis do you do to try to assess?
I would start with gross history. So suppose they are reinvesting half of the earnings, and you think that at fair value, the earnings return ought to be about 8%.
Right.
So that means they're reinvesting 4% of your money at fair value. Does it look like earnings or any other measure of intrinsic value are growing at 4% a year? And there are lots of companies that retain a lot of earnings, and you don't see any earnings growth beyond the organic growth at all.
Right.
And that means that the return they're getting on that is close to zero. So that's where I would start. I would start by asking, is the historical growth rate seem to identify or be associated with positive returns on those retained earnings, commensurate with the amount of retained earnings? Second thing is I would look qualitatively. The highest return investments in franchise businesses by far are operational improvement investments. They're investing in reducing costs. We know when we look across companies that the most efficient company in an industry, typically with the same technology, the same kind of labor force, the same capital intensity, has a cost structure a half to a third of the industry average. So there are these enormous unexploited cost savings that you're only going to take advantage of slowly over time, but you want to see a budget that's devoted to that. If the budget is devoted to expansion, you want to see that they're expanding where their competitive advantages carry over. And in China, there are no competitive advantages because it's very dense. So anybody can enter the market at slow scale, and it's changing really rapidly. So there's no customer captivity. So if they're going to China and they think they're going to create a lot of value there because, you know, it's a fast growing market, they're just kidding themselves. So you want to look at the quality of expansion strategy. First, within their existing market, like when Walmart goes from basic Walmarts to super centers and adds food, because there you're protected fully by the barriers to entry. Next, adjacent markets where barriers to entry carry over. Third, if you have to, go after other markets where there is no existing dominant competitor and you think you can dominate those markets, but do it one market at a time. And if they're not doing that, they're destroying value.
Very good. So let me then think slightly differently then about, let's go to this issue of the fade rate a little bit. You were mentioning, rules that we can follow. I assume they're industry specific. It's something about that particular industry that informs your estimate of the fade rate to do the appropriate correction in the return calculation, so you have enough of a margin of safety. Do I understand this correctly?
Yes, that's exactly right. And I think also there's a way to think about it,
right,
which is start with 20 years from now and simply ask the question, do we think, and I'll use a specific example, do we think railroads are going to be a critical part of the transportation infrastructure 20 years from now? And if the answer to that is yes, then the half-life is certainly longer than 20 years. If you think 40 years out and you think basically by 40 years out, we're going to have smart trucks. And smart trucks are going to be organized into basically truck trains that are driven, 4 feet away from the truck in front of them and drafted with nobody in the cab because they're all run off GPS systems. Then it's not clear, especially if coal goes away, what the advantage of trains are. And basically, for roads, you've got a shared use right of way, which is extremely efficient. For trains, you don't have that. And so I think if you look at 40 years and you say, okay, I think that there's a reasonable chance 40 years from now, these are going to be dinosaurs. I think then you would say, okay, that fade rate is 72 divided by 40, which is, if I'm right, 1.8%. Whereas if you think it's going to be gone in 20 years, it's 3.6%.
Yeah, no, I think it's quite useful to think that way in terms of different scenarios and how you see about that. Can I bring you back 1 second, Bruce, to this issue of, so there are a lot of questions in the Q&A tab about technology and how do we think about technology in this context? There's a very clear association in many minds between tech and growth go together hand in hand. And I want to ask you something that has always presented some difficulties for me, which is the idea of expensing growth capex. That many of these companies are in the early stages, perhaps because we're developing a new industry, say the cloud, or a new technology. And as a result, you want to make an assessment of whether you want to buy a share of that company. You may have very low earnings on account of the enormous amount of investment that is being made in the early years of that company, and you're called to make an assessment of that. How do we approach that problem?
Okay, I think there are 2 ways to deal with that question. The first is this a nascent company in an emerging market? And the ones that I would talk about there are, is this a self-driving car company? Or is this even a Tesla of the world? Well, the question with those companies is that those are emerging technologies, and emerging technology markets usually have not stabilized yet. So that you don't have customer captivity because most of the customers aren't in the market yet. And you don't have customer captivity because the technology isn't that stable, and buyers are always looking around for new technology. And nobody yet really has scale compared to the full size of the market. And if you see that happening, I don't care how fast this company is growing at the moment, you're not going to be able to predict what that company is worth because you're making 2 bets. One is that when the market stabilizes, this is going to be the dominant company. And 2 is that you have an idea of what this company is going to be worth and what this industry is going to look like in the fairly distant future when the industry settles down and you have a dominant competitor. And I think, remember, there is a too tough to call pile. And I think nascent technologies all fall in the too tough to call.
So so let me ask you.
Let me just.
Sure.
Okay.
Go ahead.
Then you've got the case of the Googles of the world, the Microsofts of the world, where the market is stabilized. And there, I think you can certainly say, you can do a long run view. So Google, for example, is a form of information advertising. It's what you go to when you've made a decision to buy, like the Yellow Pages or the classified ads, and you want to find out what the price is or where you can go get this. Well, we have a long history of information advertising, and it typically grows about 1% faster than GDP. And you can go ahead and say, okay, in the long run, this is going to be the growth rate that I'm going to apply. And don't try and guess the interim growth rate, or I think, try and guess the ultimate market size of this company, because that's going to be very hard to do. So just apply that long run growth rate. And if it's a bargain at that long run growth rate, as it was for Google in 2011, then that's going to be a good investment. But inherently, you're going to be very conservative there. Yeah. Because you're in an environment that's very, very tough to predict. And again, value investing is about knowing what you're buying.
Right. But can I ask you something, Bruce? I mean, and hey, I'm a glutton for punishment. So let me push back a little bit on this. Okay, let me see if I can get you. Like, if I think about Google, you brought up the example of Google, right? I mean, one of the interesting things about Google from the very beginning is that, to some extent, the sources of customer captivity were quite clear. And this kind of intemporal tie-in by which your search becomes better the more you search. So you're uncomfortable to do that type of qualitative analysis early on in the history of the company? You're not comfortable? I mean, I know of fewer economies better than you are.
Yeah, let's talk about the history of search. So, Google goes public in 2004, but it becomes Google around 2001. Right, exactly. Before that, who are the dominant search engines? I mean, it's Inktomi as a real vogue, and everybody decides that's going to dominate things. And then AltaVista comes along and wipes out Inktomi. And then Google comes along. I think it's very hard to tell, unless you are a real expert in that industry, that finally Google has solved the search problem. And that there are not going to be big improvements over Google. And this is once you start to see that, of course, you do see that Google is very good at protecting its dominant market share.
Right.
It's very good at improving the search experience, improving the advertising experience over time. That makes it very hard for entrants to catch up to them. But I think until that point occurs, you're going to be speculating and think how much money could have been lost in Inktomi or AltaVista.
Got it. Okay, so I don't want to run out of time for other questions that I want to bring to your attention, as well as some of the questions of the attendees. So let me switch gears a little bit, Bruce. You and I spoke in, I believe sometime during August, I believe it was, about this issue of the performance of value versus growth. And given that we're talking quite a bit about that topic today, I think we should bring it up again and have a good discussion about kind of the secular aspects of traditional quant value strategies, I would call them that way, and why have they performed so poorly? So do you have a view on that? Do you have a view on why value? I'm sure you have a view because you have a view on everything.
Exactly. I do. And that's why you're laughing. Earlier, but anyway. I thought our timing was not so bad with this book as it was in the 2000 book.
Right.
If you look at the broad sweep of industrial history, and I'm going to talk about the United States here, but it clearly also applies to Europe and to the developed countries in Asia. There are two basic transformations that take place. The first is you go from agriculture to manufacturing. And the second, which you're in the process of doing, is you go from manufacturing to services. When you go from agriculture, which is disaggregated, where people in the small institutions, small farms, people work individually, to manufacturing plants where people work collectively and they're big institutions, all of a sudden productivity growth really accelerates because you can put engineers to work. You've got lots of workers interacting and improving the process. And so post-World War II, when this transformation is achieved, what you see is very rapid growth in economies in Europe, but also in the United States after the war. It's unprecedented. At the same time, what you have for manufactured outputs early on is you have national markets. And the national markets are ones that national companies can dominate. So you look at the industrial companies in those days, it's the General Electrics, the General Motors, the IBMs, the DuPonts, the Mercks that dominate US markets and make a ton of money. They are, in fact, franchise businesses. And that is a golden age for returns on capital. General Motors returns on capital at that time, from sort of after the war through the 1960s, are well above 40% a year. But over time, what's happened to those markets is they've globalized. And as they've globalized, the required minimum scale that you need to operate has gone down. And competition has intensified and entry has intensified. And the long run trend, sort of post 1960, has been one of declining profitability, of declining barriers to entry. And therefore, over that whole period, growth returns have been disappointing. That the Nifty 50 didn't just fall out of favor because they were overpriced. They fell out of favor because they were overpriced and the returns were uniformly disappointing. That trend meant that if you were a value investor who didn't buy growth, by almost that judgment, you were going to be performing relatively better than the market on average. Since roughly the late 1980s, early 1990s, when we moved to services, the opposite has happened. On the one hand, there's bad news. Service organizations, service productivity takes place in relatively small organizations. People, even in universities and hospitals, work individually. So what you see is slowing productivity growth and, by the way, a much more uneven distribution of income. But here's the thing. Service markets are local markets. They're goods that are locally produced and consumed, and those are small markets that people like Walmart could dominate. And that meant that over time, barriers to entry were increasing, monopoly profits were increasing, and the value of growth was increasing. And then in technology, a trend is taking place that actually intensifies those problems. So what happens with technology is you go from a case like IBM, where IBM does everything, that you don't do piece parts that the consumers of the technology put together, to a post-PC era where value chains are disaggregated and everybody has a small piece of the technology. Google dominates search. Microsoft dominates only operating systems and then operates at the edge of that. Adobe does fonts and video processing. Oracle does only databases and sort of related applications. Salesforce does only Salesforce management. And as that happens, technology has balkanized those markets. And remember, small markets are your friend. No. They dominate those markets. And the trend is that they make above average returns, and because there are barriers to entry, growth is more valuable. So I think what you've seen, and you can see it, by the way, in the US profit data. In the late 1980s, early 1990s, profits were about 8 to 8.5% of national income. Today, it's between 13 and 14%. And that's all this sort of these moats, these markets that can be dominatable coming into focus. And that means growth has been more valuable. And if you're not on the growth train, buying growth intelligently, you're really going to suffer. And I think that's why I say for this book, I hope we've done something that actually gets the timing right to help value investors adapt to an environment where they're going to have to start thinking about paying for growth.
Yeah, exactly. So, but, Luis Sillas, who's an attendee, is asking almost as his own cue, whether the FANGs are the new Nifty 50. But clearly your answer to that is no, precisely because they're specialized in the services they provide.
Yes, absolutely. And when they try and go outside their specializations, just look at the non-Google part of Alphabet. It's not worth squat. They don't make any money. So as long as they're disciplined and they stick to those market segments, they're going to continue to benefit. Also, manufacturing companies like Deere that have very well articulated local service and software support operations, so they dominate local markets, are going to also do very well with growth. So I think this is a different world. I don't think this is 2000.
Bruce, I mean, one of the questions that is coming quite often in the Q&A tab, and that I would like to spend some time, you know, many different ways in which people are asking this question, is whether you feel the method is applicable across all industries, whether energy, tech, you see, you know, whether particular industries. So someone asked the question about, can we apply this framework to banks on account of how highly levered they are, for instance?
Okay, the answer is, it depends whether they're franchises or not. If these are big global banks competing in global markets, forget it. It's going to be asset value, earnings power value, because they're not going to dominate those markets. If these are banks like M&T that started out dominating Buffalo, and Buffalo is an unattractive enough part of the world, so if you're willing to hold your nose, you can dominate it and then expand it adjacently going down I-87. Those companies you're going to have to evaluate in terms of returns. But let me say this. Inherently, these return calculations, I hope it's clear, are much more complicated than the asset value calculations, because you're looking into the future to do them. That means that you're going to have a higher degree of industry expertise than you have in the past. And I think that means in turn that value investors are going to have to become specialized. And I think they're going to have to become specialized by industry. And I think they're going to have to become specialized by country, because that's where the service operations occur. So I think the answer is yes, there are banks that look like this, but you better be a banking expert if you're going to do a good job of applying this framework to get what these banks are worth. Now, let me say one last thing about this. You'll notice that this helps you at the entry point. You have a price that's given to you by the market, you can calculate a return. It's not going to pick the exit point for you.
Right.
When you pick an exit point, you basically got to pick a price, and these returns are not particularly sensitive to the prices over fairly wide ranges. So, and I think this is the experience of good growth investors, that the buy decision is one that's manageable. The sell decision is brutally hard. And typically, people like Warren Buffett just have arbitrary rules. He never sells. Seth Klarman would never pay more than 20 times earnings. I think he's up to 25 times earnings.
Right.
But, you know, there's going to have to be an arbitrary choice there. So I think there are industries where it's hard to apply, and you've got to be an industry expert. But yes, I think this applies to all franchise businesses. And if it doesn't, ask yourself this: how are you going to value those businesses?
Right, right. So, you know, an attendee, Adriano Duriguel, asked a very interesting question, which is, and it's something you and I have discussed in the past, and I want to explore this topic with you, which is, how do you retain the kind of the value investing mindset when thinking about growth? I mean, you and I have talked often, right, that growth lends itself to all these behavioral biases. Because you start projecting, you start getting enamored about the kind of convexity of growth and the extra kick that you can get out of the valuation if growth happens to surprise on the upside. It's very easy to fall prey to all these behavioral biases. So have you thought a little bit, Bruce, about kind of these organizational rules that we can have to protect ourselves against these type of biases that are inherent to growth?
Okay, so let me say the first thing about this growth return. It's linear in the various elements.
Right.
So when you do a sensitivity analysis, it's not doing a complicated series of Excel runs with different values. You have an, you know, if the cost of capital is 1% higher, your margin of safety is 1% lower. If the organic growth rate is 1% higher, your margin of safety is 1% higher. The earnings, the current earnings return and sort of the reinvestment return, you can calculate based on history. But you know the effect of a value creation factor of 1/2 versus 1. It adds linearly to this return. The advantage of that is that if you're a good value investor, you want to start with a conservative estimate where you're pretty sure that this is going to be what organic growth is going to be. And the most conservative estimate for these things, unless it's a dying franchise, which is brutal, is going to be just GDP growth for the growth. But you start with that conservative estimate, and then you can tell immediately what the impact is going to be of things being better or worse than you thought, because it is linear in the organic growth rate, the cost of capital, and it's linear in the fade rate. So I think that's the other thing that's crucial about this. And again, it really is part of the Graham and Dodd genius. What they do is they develop a very simple, transparent framework for incorporating the information about the world that you collect. So much more, asset value, earnings power value is a much more transparent framework than a DCF framework. So when you do the sensitivity analyses in your head, you can do them that way. You're not giving free rein in the context of a complicated calculation to your hopes and dreams.
Yes, I'll go back to the point of the DCF because in a moment, but because I know how to press your buttons, and just to get you overly excited, Bruce, there's a question by James McNay on Amazon and kind of the value created by Amazon. And he emphasizes these two sides of Amazon, right? The retail part that you and I have discussed at length with the students over many years, and of course, AWS, Amazon Web Services, where there may be potentially more sources of customer captivity. And, it's one of the obviously most successful companies in the US universe over the last few years, and so on and so forth. How do we explain that success in a particular business? I think AWS is a different thing, but it's a surprise, so to speak.
Oh, no, it is very rare. And again, let's go back to Google, which is a bunch of really smart people.
Right.
The companies do well in multiple businesses. If you go back to Microsoft, Xbox, which is a different business, they just don't make money. They finally profitable marginally, but it was a very bad investment. It is very rare in this context when we're passed away from General Electric, we're away from General Motors and these great big industrial companies, that companies are good at many, many things.
Right.
So I think that when you see Amazon be good at multiple things, you have to say, okay, that's lucky. I mean, General Electric was an exception at doing many, many different things until it wasn't. And I think Amazon has been an exception on this. It's done exceptionally well in web services, and it's done sort of well in retail. But I think there is some good news about Amazon. My guess is, and again, think 40 years from now, the trend in technology is that it's interchangeable. If 40 years from now, or even 20 years from now, the web, God, what's it called? Cloud computing is not a commodity product, I will be amazed. And people will come in and they'll just switch you at no cost, and it's going to be a competitive, because it's a huge market. And
there are already technology solutions to facilitate that.
And I don't think anybody's going to dominate it. On the other hand, if you look at Amazon's retail business, there are two parts to it. One is there's the web retail front, which is transaction processing. And two is there's the distribution network behind it. Net retail fronts are a dime a dozen. Nobody's going to dominate that. It's too easy to use Google to find things. On the other hand, distribution is a series of local monopolies.
Right.
And Amazon has gotten much smarter about that. So if you look at Amazon globally, they were going to do everything. And now they've decided to concentrate on India. If you look at the way they're building out the distribution network in the United States, they are sequentially trying to dominate localities before people with dominant local distribution networks like Walmart get into the business. So at least in that dimension, they seem to have gotten.
Thanks. Bruce? Bruce? don't know if I've got disconnected. Meredith, I don't know if you can come in 1 second.
Smarter.
Oh, there you are. Sorry, you got disconnected.
Tano, you're frozen up.
Oh,
We can hear you now. You're
froze up.
back.
Yeah.
Oh, on my
you're
internet.
back.
Okay. Can you hear me?
I can hear you. Can you hear me?
Yeah, I
yes.
can hear. You're fine. Okay.
Okay, great. Great. Yeah, you froze there for a little moment. Were you done with the Amazon answer?
Yeah,
I'm sorry,
yeah,
I couldn't
I hope
quite hear
so.
the end. Yeah, very good. So before I want to pivot then to the last topic of today's conversation, there are several questions about kind of the general economic environment and what is that we can hope for markets going forward. There are a lot of questions, Bruce, about the very low interest rate environment. What does it mean for valuations? What does it mean for looking for good investment opportunities out there? Whether the investment environment is strange or peculiar on account of the incredibly low interest rates that we have all over the place and the very low yields across asset classes. And what does it tell you about current economic conditions and where we're going from here? So why don't we start with financial markets and then we go over the economy at large on account of this very peculiar environment that we're experiencing.
Okay, I think actually the fixed income returns are crazy. And I think that from 0 to negative, expecting them to go down lower so that you make capital gains on your fixed income securities is just not going to happen from here.
Not going to happen, yeah.
So I think the fixed income returns that people are going to get, which are going to be sub 1% on safe assets, are going to be wholly inadequate compared to historical experience. On the other hand, the striking part of history is if you had invested, in 2008, right before the crisis, sort of the middle of 2008, from 2008 to today, you would have made a 6 to 7% return, which is very close in a low inflation environment to what equity returns are.
Right.
And those are pretty good returns. And I think that the weird thing is, and it's been sustained now for at least 7 to 8 years, is while these fixed income returns are crazy low, the equity returns have not been crazy high. I mean, the FANGs, they've been crazy high in some sense, but again, that's because people are willing to pay for growth rates that are very hard to judge. And I think that sensible value investors are going to stay away from that. But still, there are extraordinary opportunities for companies. And again, I don't want to sound like a broken record, but companies that understand local market domination in services. And Deere is a classic example. I mean, there was this huge disagreement between me and Jim Grant when Deere was at 75. And he thought it was going to 25 because in traditional terms, demand was going to fall, and it had. And they were going to be loss-making for an indeterminate number of years. Well, life had changed. They were no longer a competitive equipment maker. They were a monopoly service provider. And I don't know where the stock price is today, but I think it's well over 200. I think it's like 225. So I think there are extraordinary opportunities here. And an overall level of equity markets that is not all that crazy. I mean, there are obviously areas of valuation that are out of hand, but that's what value investors typically avoid.
Right. Very good. And so I completely agree. But can I ask you something a little bit about this? I mean, so I want to explore one thing a little bit more deeply, which is one thing that worries me. I was talking, I don't know if it was in the podcast or elsewhere, with Lee Cooperman, and he had a very interesting insight. He was saying, look, in a world where yields are so low, the problem is that you're going to have a lot of investors that are outside their preferred risk habitat. And that's distorting prices kind of everywhere. Do you agree with that view that to some extent what we're seeing is the search for yield distorting prices left and right? And as a result...
Okay, I have to say that I don't know about most prices. But in terms of equity prices, the multiples of current earnings, and I think current earnings look not only sustainable, but for many of these unrecognized franchise businesses that are well run, there is a growth element to the return that doesn't get figured directly into the PE. I don't think that the equity prices have responded. I mean, they just have not gone up that much. And remember, profits from, so look, let's just say that profits from 1990 to 20 have gone up by 60%. That's about the profit share of GDP. So it's 60% above the growth rate of GDP, whereas historically it had been at or below the growth rate of GDP. Well, 60% over 20 years is like 2.5% a year. So that's an additional 2.5% return that's being driven by these economic forces that we've talked about. And if you add that 2.5% return to current earnings, what you're starting to see is multiples that are not that crazy. So I think that in stock markets, you haven't seen this. I don't know, what's happened in real asset markets, although certainly oil wells are not trading that expensively. And I don't think timber is trading. Commodity prices certainly haven't gone through the roof. So I think fixed income is crazy. I think it's insane. I've thought it's insane for a long time. But, there are these other pockets where you can actually look at, based on a reasonable judgment about the continuities of history, what kind of returns are in work. And the equity prices don't look crazy.
So, there's a lot of questions about whether you would be willing to talk about things that you like in the market specifically, that you've looked at recently that you like. I know that you're always reluctant to share your views on this, but I will be a faithful host and convey the questions from the public on this call.
Well, all right. So let me talk about an opportunity that exists in the market in one company actually in Sweden, but really is a much greater opportunity. And you want to think about companies that take advantage of opportunities like this. When you look at electrical or plumbing contractors who do jobs for big construction projects, that's an incredibly balkanized market. There are a lot of little companies in any city. And if you look across cities in a country, there are lots. There are literally hundreds of companies like this with 40 to 60 employees. There is a company in Sweden called Instalco that I think started off in Gothenburg with a 30 million euro investment and decided that as these old guys who ran these smaller contractors retired, A, they could buy them out at a relatively cheap price, 4 to 5 times earnings, and B, by putting them together, there would be economies of scale in force deployment, in bidding for opportunities, in purchasing, and in other just overhead functions. And Instalco, as I say, which started out as a $30 million euro investment, it's been up and down lately, but the market price, which we bought into at, I think about 45, is over 200. I mean, it's something that's done really well. And you can see how opportunities in small, balkanized local markets like that would exist if you're intelligent the way Instalco was, where they did Gothenburg first, then the rest of Sweden, then very carefully Norway and parts of Finland, where they thought they could dominate. And you can see countries like Switzerland and Austria in Europe, where probably somebody could do the same thing because they're isolated, smaller local markets. Conceivably, in the United Kingdom, it might be the same, or parts of France. But there'll be opportunities like that locally in the United States. So I think that those are looking at industries with opportunities like that and looking for companies that have the ability to take advantage of that because they understand structuring local economies of scale and a disciplined expansion strategy is where you're going to make money.
Okay. So I want to finish a little bit. There are several questions about the future of value investing, Bruce, and a little bit how we think about value investing going forward. I think the second edition of the book, To End Where We Started, answers the question of growth, which is the way forward. And I want to ask you two things about this. One is, value investors do the hard work of actually reading the annual report, thinking through the economics qualitatively, and so on and so forth. technology has, made a difference in many industries, in many types of jobs. Do you see the job of a value investor being substituted at some point by a piece of software, artificial intelligence, that can do what we do? You think that, we have several students asking, young Ryan O'Neill from Ireland, who is asking about this, whether he should consider learning value investing, given that he's worried about the future of technology, taking away his dream job as a value investor in one of the big value investing shops. So what are your thoughts of that?
Okay, I think that in a sense, this necessary movement to doing valuations of growth is a godsend on that dimension. Because judging future growth is something that's very complicated and very specialized to do. It's like historically looking at reproduction values of assets to validate earnings power was something that took a lot of detailed industry knowledge. It changed relatively rapidly as industry technologies changed. So I think the first thing that's going to happen is that value investors are going to have to be specialized, because they're not going to be able to do these complicated tasks well if they're not specialized, not only, by the way, probably by industry, but also in many cases by geography. I think because that's where you're going to get to know managements. And again, when you talk about the future, managements have a much bigger impact than just sort of the asset-driven histories that value investors have dealt with in the past. I think it's going to be very hard to do general models of that sort. I don't think you can. So then the question is, are people going to do it industry by industry? And we haven't seen that in the artificial intelligence business, not even close. I mean, the models are all cross-industry, cross-market models with necessarily, therefore, simple, unambiguous measures of value. So I think the answer is no, but you're going to have to be a specialist in 1, 2, or 3, maybe 4 industries at most, which is what Buffett seems to be able to handle. So that, I think, is the answer to that question. And if you're disciplined about doing that, you're not going to be replaced by a machine within the next 30 years. Having said that, though,
right,
there is a problem out there that I don't think we solve in the second edition. And we've talked about this, Tano. We count on you to solve.
Yes.
Specialist analysts still have to contribute to people who are going to build diversified portfolios. How you manage risk in this environment is a brutally difficult problem.
Absolutely.
And I don't think anybody has a good answer to that for the moment. I think value investors have a better definition of risk. But how you position size properly, how you combine things across, different countries, different asset classes. I think there aren't going to be models that do it. And I think Tano is going to train, what's his name, Riley in Ireland,
young,
to do that really well.
Yeah.
And it's going to involve a serious intellectual effort on his part for the next 20 years.
Yes, I think this is exactly right. That the definition of risk for value investors of permanent loss of capital requires a different way of thinking about risk management relative to how traditional business schools teach this, and that remains an open question. So let me just finish with one question that people are asking, which is, when is the 3rd edition coming out, Bruce?
Never. Now, let me say why. For this business, Judd and I have written 2 books. One, which is Competition Demystified, was actually a good book, and we're never going to have to produce a 2nd edition. The first value investing book is actually not a good book. I mean, there's this huge area that, if you look at the examples we did, so the way we tried to value Intel and WD-40, it was incredibly feeble. If you look at the 2nd edition, we've really actually done a good job. And since we've done a good job on the 2nd edition, and Tano is going to be responsible for the risk management and position sizing problem, there is never going to be a 3rd edition.
But we'll hear much more from Bruce in future occasions. So, Bruce, thank you so much for, again, doing this wonderful event. and for all the insights. That it was a wonderful lecture. To all of you out there, thank you so much for participating, and stay tuned for more events from HelpRoom in the next few months. And again, Bruce, thank you so much for such a wonderful lecture.
Thank you for being a great interviewer.
Thank you, everyone. We'll see you guys soon, and stay safe. Bye, everyone.